The Business Channel. Might start with you. Your thoughts on what to expect for the session today?
Thanks, James. I guess looking at the Australian share market, and one thing we didn't see yesterday was the material space participating in the rally that we saw on the Aussie share market. But it looks like today we might see a little bit more support coming through from those big material majors. BHP saw a gain in both London and New York. In London, it was up by 1.3%, and in New York, it was up by 0.5%. That's despite in the US, we saw a record performance, but we didn't see the energy, the materials, and the industrial sectors, the typical growth areas, really participating in that record rally on Wall Street. But we did see a good performance from the US stock market. The healthcare stocks really soaring there. Europe was at a 2-month high, so that really bodes well for markets around the region today. In terms of economic data, though, it was a different picture. In Europe, we saw EU unemployment hitting a record of 12%, and we also saw factory orders shrinking at the fastest pace in around about 3 months. Over in the US, we saw those factory orders and a surge of about 3%, beating expectations. Of course, over here, what we're going to be watching is a trade deficit today here in Australia. We're expecting to see a deficit of $1 billion. And of course, the China non-services PMI number also out. So we'll be watching that services sector in China. But altogether, it does look like it's going to be a good day for the Aussie market. The SPI futures up by 0.4%.
And over 2% at the moment, Julia. I mean, do you see any potential catalyst for another run up in the gold price? I mean, putting in perspective, I mean, it's had a hell of a run and still at reasonably elevated levels, but it's on a bit of a downtrend at the moment.
I mean, if you have a look at the investment case for gold, a lot of the investment side of gold comes from, I guess, expectations of money printing, which we're still seeing all over the place. But I guess the key country that speculators are watching is the US. But if we have a look at the demand for gold, it's not just investment demand. And if we have a look at central banks around the world, they've still been buying gold. If we have a look at 2012, we ended off the last quarter of the year with central bank buying being at the highest point for the year. So the demand still is there for gold, but we have seen gold prices now languishing because some of those fears that have been present over the last few years are now starting to fade into the background. If we have a look at the gold miners, they have been strong underperformers of the gold price. And if we have a look at this industry as a whole, what we are seeing are declining grades. The easy gold, the cheap gold to extract has now been extracted. We don't really see new huge gold discoveries. What we do see is the use of new technologies to try and get deeper down into the ground and to extract gold. So what we are seeing with these lower grades of gold, higher production costs. So if you do start to see the price of gold languishing and the cost of production rising, well, then that's a double negative for gold miners, and we've certainly seen that in play in 2013. Having said that, there are still some attractive gold miners out there in the market. If we have a look at mid-sized gold stocks like Regis Resources, a strong growth profile, low cost of production. So there are still some good gold stocks out there, but unfortunately the whole sector has been sold off quite indiscriminately. So we are seeing gold stocks pretty much coming under a fair bit of pressure in 2013, and that's really because of expectations that we could see the end of quantitative easing finishing in the US on the horizon.
Julia, we were just talking about those levels of Newcrest below 20 for the first time since 2008 lows. Let's mention Whitehaven because it's seeing some decent low levels at the moment, the lowest that we've really seen in years for that stock, certainly post-GFC. I mean, we're aware of Nathan Tinkler's problems, but is that the only problem that stock's got at the moment?
I think that's the key one. Nathan Tinkler selling his farm, really putting into focus his holding in Whitehaven Coal. It's got a 19.4% holding, and the stock yesterday saw a post-GFC low of just $2. Now, also, there's been a bit of chatter around the market around this Noble offtake agreement of 1.5 million tonnes from the Maules Creek mine. But the AFI are just clarifying that that's been renegotiated to 1.2 million tonnes and that there is the option of rolling that into 2015. So it does look like that's a bit of a smaller concern. But in the face of that big drop that we have seen in Whitehaven Coal, the stock's down 42% this year so far. We are seeing some brokers becoming quite positive on the stock as well. We have a look at Deutsche Bank. It turned up on the substantial share register yesterday. Bell Potter also has Whitehaven Coal as the coal pick in the Australian space. And really, if you are investing into a company like this, you are doing it on the back of expectations that we are going to start seeing a rise and a recovery in in the coal price, as well as perhaps a weakening in the Australian dollar as well. But Whitehaven Coal, $2 yesterday, it's down 42% for the year, so it's starting to look interesting if you do think that coal prices are going to recover, but certainly Nathan Tinkler's troubles not helping this company at all.